Okay, so I've been sent a couple of articles by actually a couple of different clients of these two. This is why I've picked them, which makes a few claims around budget myths and what the tax outcomes might be of these proposed budget changes. So because I've been asked to sort of go through these and assess the claims, if you like, I'm just going to quickly walk through two articles. So let's have a look. Let's have a look at the claims. So this first one is an article by The Guardian, essentially why massive tax bills and investor exodus fall short. Okay, so what are we saying here? So the first claim is that the capital gains discount hasn't been scrapped, it's just been changed. And instead of going back to 50%, it's gone back to the indexation method, which is true. And this article even gives an example that says, okay, if you earn 10% here, for example, then the discount would be 25%. But if you earned 5% and inflation was 2.5%, then it's roughly the same gain. So mathematically, that's basically true, right? And in fact, if your growth earning rate is less than double inflation, then obviously your CGT discount's a little bit better. Okay, so notwithstanding the fact that these new rules also apply to pre-CGT assets, which initially were exempt, what this doesn't really recognise is that in 1999, and we talked about this in the follow-up video, indexation used to also apply to companies. And so investment companies used to get that indexation. So companies are still now being subject to capital gains tax on the gross gain. Okay, so yes, we're going back to the old regime, but we're not going back entirely to the old regime because we're not including companies in that regime. So what we've effectively got is a non-refundable franking credit, for want of a better term, of 30% that's being added to discretionary trusts. And we are removing the discount so that higher growth assets will be taxed more punitively than lower growth assets going forward. So are small business going to be hit? There's that claim as well. Yes, the small business tax concessions weren't included in this, and they are a very significant benefit to a number of small businesses, but they're not necessarily something that every small business can take advantage of, or not something necessary that they can take advantage of entirely to its limit. So so that's I'd say that's sort of 50-50 there. Yes, it's true that they haven't been targeted. They still apply, but again, and the small business tax concessions are something that most small business owners should try and avail themselves of when they can, but it's not necessary that all small businesses can, or that they're able to take advantage of beyond a relatively small amount because of the way the tests work. Okay, especially if there's a number of partners in a business. So the more partners in a business, the more that kind of gets diluted in practical sense. The other big thing it talks about is this sort of meme campaign, which I find, like most comedy, it's funny because it is kind of true around this whole idea of, hey, now, Anthony Albanese has now become a shareholder in all small business and taking 40% of the business profits. Is that really true? Again, no, not strictly true, but it's probably closer to true than not true, or at least very arguably, and it certainly has very much, from a company perspective, it is very much the case in the sense that there's now going to be no discount of capital gains inside the company because companies don't get indexation. And when those dividends are paid out to shareholders, if those end shareholders effectively get top marginal rate, the fact that the company has paid tax at 30% or 25% as a trading company, that tax credit is provided to the taxpayer, but the taxpayer is still, the end taxpayer, shareholder in this case, is still going to end up being assessed on the entire profit. So you can very well end up paying 47%. They just might have done it in instalment of, say, 25% in a trading company and more later, or 30% in a non-trading company and more later. But that top-up tax is going to get them to that effective rate of 47% anyway. That's kind of what that meme's about. So the idea that it's that the capital gains tax discount is going to apply when many, if not most, small businesses either are or certainly will be going forward be run inside companies, then yeah, that campaign really is more true than not. Will it make a difference between starting business in Australia or overseas? It absolutely will make a difference. Now, how much of a difference will it make? Businesses that need the necessary connection with Australia, whether technically under tax law or in practical sense, obviously don't have a lot of choice. But businesses are increasingly ideas-based, not physical capital-based. And the more ideas-based a business is, the more mobile that capital is. And we see that in jurisdictions like Europe and the US, where it's relatively easy for owners of businesses to shop around, if you like, for want of a better term, where they have their tax jurisdiction. So we see a lot of businesses in the US move from states with state income tax to states without income tax, because if California or New York in particular are putting up their income tax rate, ultimately it makes sense for businesses who can to relocate to states that don't have state income taxes, where their ultimate tax take is going to be lower. Even if it just means that they're able to reinvest more into their businesses. And similar, we have even tax havens and jurisdictions in Europe where there's little or no tax. So we increasingly see people domicile in those locations when they can, obviously because it makes a huge difference. Will it change negative gearing and GGT for rents? That's a much bigger question. The reality is it can't not. But again, it's only one measure in isolation. Can there be a bunch of other factors that may drive that? And that's probably a bit too complicated question to answer simply. But the government's own modelling suggests that it's not going to have the effect of making houses more readily accessible, particularly for first-home homeowners. So that seems a little bit sort of counterproductive, but I wouldn't say that's as simple. Should people sell now to avoid big tax bills? The short answer to that is no, not really, because there's a staging of these provisions. So even if currently those assets are CGT free, they will be up until the measures take effect next year. And then even after that point, whether they were CGT free or 50% discount, then the new measures only apply from that point on. So the question will be, do you get a valuation at June 30 next year, so that you can apply proportionally those gains in the most advantageous, because most of the gain you think or potentially will have been up until that point, versus the rate of gain in the future? Or if the rate of gain in the future is likely to be much higher, then there may actually be some degree of benefit in just simply averaging those gains out over the entire lifespan. That's a much more complicated mathematical calculation, but essentially no, there's no obvious answer to say, hey, everyone should sell up now and restructure, particularly when the governments have made the claim that they will, or said that they will allow restructure without penalty. Okay, the other one that I got a lot of, well, quite a number of people suggesting is this one here, which is an article by the Australia Institute, which now deals with how much tax distributions are going through trusts. This one's a little bit more subtle, I guess, and complex. I'm going to sort of walk through this one a little bit more carefully, because I've had a number of people send this to me, but with sort of different questions. So let's look at the claims of this one. So basically, the suggestion here is that, okay, that there's 4.9 billion in foregone revenue. So this is revenue that the government hasn't collected as a result of these taxes. Again, without getting into the calculation of those, there's a number of different people who've done those calculations a different way. However you want to slice that particular pie and calculate that number, it assumes that the government would have collected that revenue had this particular provision not been in place, and ignores what the logical alternative may or may not be, because no one really knows what that is. Sometimes they make some assumptions, sometimes they don't. Depending on how you want that number to be big or small, you can manipulate that number a lot. But the idea of the cost to the budget is one where revenue hasn't been received. Useful calculation in trying to understand policy effects, but the idea that that's exactly the same as spending $4.9 billion on whatever government expenditure there is, those two things are obviously completely different in practical reality. But it's, again, if you want to create a position, I suppose the first thing you do is you use truth to tell lies. You use numbers that are factually, objectively correct, and you just use them out of context. So the next point here is Treasury data. So the trusts are overwhelmingly used by the wealthy Australians. The top 10% of income earners receive 63% of trust distributions. Okay, so why is that? We've covered that a little bit in other videos, but the short version of this is the use of trusts have exploded, and we'll go through these details in a minute. Particularly since the capital gains tax legislation was changed in '99, precisely because companies lost indexation of growth assets. So the capital gains tax discount that companies used to get because they could index the real cost, that disappeared. So companies now were punitively taxed relative to all other vehicles for owning growth assets. So what happened back in 1999 is, and from then on, is structuring was done differently and discretionary trusts were used, not just for protection, that's still by far the predominant use of trusts, or reason behind trust use, but they were also used for tax planning purposes, simply because, and then streaming out to bucket companies, precisely because they did get that discount of capital gains. And so it would be insane to pay potentially top marginal rate or at least paying company tax rates on the gross gain when you could pay significantly less, up to half of that, by having the growth assets owned in a discretionary trust. So the other reason why trusts have exploded, and we again dealt with this in the long form video we put out for the budget, is that the number of people who are paying marginal rates well above company tax rates, so 37% bracket and above, has increased exponentially. It's a factor of something like 10 to 15 times the number of people who are now paying those tax rates. So by definition, the number of people who are going to avail themselves of whatever tax planning they can is going to increase just in math. So that's why we're in this position, not because there's this whole sort of sudden cohort of wealthy people. The wealthiest people have always. We're moving more and more towards that. The issue here is how many people are in lower deciles are sort of caught up. Keeping in mind that because people have been structuring their large growth assets in those discretionary trusts for the last 27 years, then when those trusts realise those gains and have huge amount of distributed income in those years they realise those gains, in many cases that will be a one-off or very infrequent realisation because they're selling investment assets or in many cases investment properties, and that income is being distributed in that year. That trust is going to be in the top decile of taxpayers. That does not mean that that same trust is every year in the top decile of taxpayers, because as we dealt with in that long form video where we looked at why are those top decile taxpayers trusts, because they are realising very large. The average, or the median was something like $850,000 worth of gross realised gain. So $400,000 of assessable income just in assessable capital gain, if you like, which clearly is going to push your trust, if your trust has that gain in that year, it's going to push your trust into the top decile of income tax earners, or of income earners in that year. So again, it's a statistical category of trusts receiving a one-off, once in a lifetime huge distribution because they've sold an investment property or sold a discountable but otherwise accessible asset in that trust, maybe a once in a lifetime thing, is going to push that trust and therefore statistically into that category. That trust is going to drop out of that category and never return to that category and be replaced by other trusts that just happen to be doing in that current year. So that statistical category is always going to look like it's wealthy people, even though it's, in the vast majority of cases, people are doing this once in a lifetime or very infrequently. So that message has been lost, that signal has been lost in the noise of look at this graph and look at it's all wealthy people. So why has there been an explosion? There were 326 in 1991. By 2023, there was 1 million. We've covered why that's the case. Then it sort of goes on to sort of say, okay, well, and use this example saying that the most prominent form of households are businesses, family discretionary trust. Again, why does a business use a trust? Because a trust offers protection. Okay, so by protecting your assets, by putting trading entities in trusts or putting passive assets in trust, either way, those assets are legally separated from individuals. So in anyone who's at a high risk occupation or in business where prudent wealth protection planning says make sure you isolate your assets, so don't put all your eggs in one basket, don't leave one thread that can undermine your entire family's financial future. Trusts are used in that say. So to simply say that, well, because all of these family businesses operate through discretionary trust and they're all high income earners, they're not, because the vast majority of those trusts aren't in that top decile year after year after year. We're conflating two completely separate things. Then it goes on to give this example of saying, okay, someone earning $300 a year who divides that income between 4 trust beneficiaries, is essentially going to save 50,000, right? So instead of that sole person paying 100,000, the trust allows the four to pay 53,000. Okay, so let's explore that claim. So now we've got a trust where somehow a primary income earner is being able to generate that income via a trust. Okay, so now, is that a family business where, let's say I have a family business, I'm the only one in the family who's actually operating that business. For this to be the case, my four beneficiaries, so let's say my partner and three children in this example, all have to be not earning any income for me to be able to avail these low tax rates. They all have to be adults. They'll have to not be earning any other income for me to be able to distribute this $300,000 across myself and these other four beneficiaries and save this tax. Now the reality is, and we've talked about this in the long form video, budget reaction, is that most trusts in that situation are not going to remain in that situation very long, because very few families have three children now anyway. But even if they do, those children, once they finish uni, finish their trade, go out into the workforce, they're very rapidly going to earn 45,000, which is where that tax threshold of 30% kicks up to 37. So the reality is, very few businesses are going to be in a position where they can sustainably do this. Even if this is a farm or a family business, the reality is, if the other family members are working in that business, well, then they're employees and are going to be paid wages that get them up to that level anyway. So what this is claiming is that there's this whole band of these very wealthy people earning $300,000 a year who have family members sitting at home doing nothing, not earning any income, that they're able to routinely distribute this money to. Now, there's probably two classes of people that fit this. One is those partners in very large, accounting and legal firms who have structured their affairs in such a way that the partnership and or the law practice are structured in a way where those earnings or those partnership or practice distributions are essentially being funneled through a family trust and being passed down to those beneficiaries. That's certainly been very, very common. But having dealt with many of those people over many years, what I can also tell you is their children and spouses don't sit at home for decades on end and not earn any money. That's an extremely rare case. And even those who may be availing themselves of that might lose this. The reality is it's not going to be an overly punitive thing for them, because it's something they're only going to take advantage of for a relatively short space of time. So it's not clear exactly who they expect to be targeting with this measure consistently over time. They're really only going to be targeting those people in that relatively narrow window where they may have been able to do this while their kids were, say, at university, but clearly while they're actually going to be supporting those children. Anyway, so it then moves on to talk about trust assets being, how much percentage of households' assets. Again, it's just a big number. I don't really understand what the relevance of that is, other than it seems to suggest that trusts are the domain of the wealthy. How that compares to superannuation would be another argument. How does it compare to companies? Not very easy to measure. I think that's a bit of a red herring. Okay. They make this claim that they estimate that 600 billion of revenue was run through trust, and that being nearly a quarter of GDP. There's no, again, that's a claim. There's no validation or no suggestion of how and why that's the case. So I don't really know what to say. That the suggestion that the richest are complaining about a minimum tax rate of 30%, I haven't yet seen anything, and I wouldn't say an exhaustive search, but I've tried to at least try to understand what data is there available to see how much distributed trust income does have an effective tax rate of below 30%. There's no doubt that number would be growing because of the numbers we talked about before, but I can't see any way where that is a sustainable scenario, even under the old rules, under the current rules, simply because of all the examples I've just given. So the idea that there's this increasing class of extremely wealthy people who are continually be able to avail themselves of this loophole, I just cannot find any data, and this article's not providing any either, to suggest that that's going to be an ongoing sustained scenario for all of these trusts. That trust taking advantages today, 10 years later doing so. The next comment probably is gives you an indication of the, let's say, the thinking or ideology behind this. So they've made the claim here that that this particular strategy or this particular, inequity was raised by Ken Henry in his tax review back in 2010. So I don't have a graph that goes back that far, but we do have the graph that we've been through a number of times, where we look at the explosion of the number of people because of bracket creep that have moved into the above 30% tax bracket. Now, if I go back to 2010, it wouldn't surprise you to know that number was even smaller than it was in 2015. So yes, there was a few people back in 2010 who were availing themselves of that, and for them, the gap would have been relatively slim at the time, but there'd be almost nobody who was availing themselves substantially of this benefit back in 2010, who's still getting any material tax benefit some 17 years later, simply because the bracket creep math and the fact that if they were distributing to their kids, their kids were 20 back in 2010, then the kids are obviously now into their mid to late 30s and almost certainly going to be earning more than $45,000 each themselves, and therefore not availing themselves of this particular strategy. So the idea that this has been going on, which is sort of what this article seems to be suggesting, that this is not just a major problem in terms of unfairness in the system, but it's been pervasive for a very, very long period of time. And the reality is I just can't find any evidence that's real true, and it certainly doesn't track with our experience. Clearly the Australia Institute and the Guardian are both in favour of these, because both of these, sources, I suppose, tend to be more on the side of, government should be allowed to raise more revenue because there's good things for the governments to spend money on. That's a very different argument. So again, ultimately this comes back to, is the pie large enough? And if not, how should it be expanded? Or if the pie is large enough, how should it be distributed? None of these changes are talking about distributing the pie differently. They're only about making the pie get larger. And so the conversation needs to be, first of all, does the pie need to get larger? And if it does, what is the most productive way for that pie to get larger? Because if the pie gets larger in terms of government take of revenue, but the pie doesn't get larger in terms of the productivity of the economy that's driving that revenue take, well, then that can only sort of end one way. So again, these are a couple articles that people had sent to me, so and asked me to sort of deep dive into them. There's a little bit of truth in here, no doubt, but I would suggest it's a very good example of again, using the truth to tell lies, taking some statistical numbers or some measures, not really explaining the context of where they would be inappropriate, and suggesting that they'd be appropriate in cases where they clearly wouldn't be. So I don't think this is particularly helpful, but maybe that's what it's designed to do. Now, criticism might be, well, why don't, these are relatively sort of left-wing, I suppose, if you're to look at it from an ideology point of view, why don't we look at relative right-wing? First of all, I haven't seen any that are quite as egregious as this in terms of misrepresentation. But again, if someone has a particular article they want me to have a look at and go through, more than happy to do that as well. Because, again, the reality is, the question here is, size of the pie and who pays are two very separate questions, and that they need to be interrogated quite separately. So anyway, that's my sort of take on those two articles. If there's any others, feel free to send them through as well.